total asset turnover, it's a very comprehensive, all-inclusive ratio. Overall firm efficiency, you take sales and you take total assets in the denominator. So of course, we want our firm to be producing as much in sales as possible for some given investment in assets. So we say, hey, is our firm using its assets efficiently or not? What types of assets? Inventory, cash, buildings, whatever else the firm has. Is it using it efficiently or not? So here, total asset turnover will be equal sign. Go to the income statement. Sales is the same thing as revenues. Income statement B8 / click on balance sheet. Go to total assets, which is in row 21. Is it total assets? This is total assets? No, this is total current assets. No, this is total assets. Looks like. Yes. So, okay. So very close to the industry number. Income statement B8 divided by balance sheet. Balance sheet B21. Income statement B8. The formula is sales, revenues, divided by total assets. All right, so let's copy this formula and copy these down. So JCPenney is about 2% below the norm, as I said. Anything, that falls in, plus or minus 10 percentage points is acceptable. And over time, JCPenney's, this ratio has improved by more than 10%. Okay, so they have become more efficient, so which is a good sign. But whether this improvement is gonna be sufficient or not, that's a question mark. Okay. So they have improved over time. All right, any questions? Now let's move on to the last slide. Profitability. Okay, so what is it a function of? Well, it's very complicated, as you would know. It depends on what type of product mix you have. Is JCPenney buying the right kind of product mix, the right kind of merchandise that people want? Is JCPenney pricing those items, correctly? You don't want to overprice, you don't want to underprice. Okay, so, but in my mind, yes, it could be. But in my mind, I think in a free market, costs are more important. Okay? When there is a lot of competition, Dillard's and JCPenney and Sears and Target is also into some of these things, and Walmart is also, and a bunch of companies online selling the same stuff. I think the idea is that you cannot charge as much as you want to. Okay? You cannot charge because there is competition. What you can control is your cost. Okay, so in my mind, when a firm is profitable, of course I concede readily that the firm is profitable or not is a function of so many different things. But to me, I think the most important thing is my firm cost efficient or not? Okay, you could be hiring too many people. Okay, you could be stocking too many items unnecessarily. You could be paying too high a rent. You could be operating some unprofitable stores. JCPenney, I remember, about 6-7 years ago, they had shut down this store in Hammond. They moved to Covington, where they also often offer a store. Okay, but then when the mall was renovated, this mall, they came back, and I'm not sure how profitable they are, or how productive they are, how efficient they are. So many times firms continue to operate a store when it doesn't make any sense. So that's what I'm saying. Are you cost efficient? And 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 uh, and firms realize before long that they need to shut down some unproductive stores. So which is what I'm driving at. So net profit margin. What's the formula? Net profit margin. It's net income. Okay, net income, and for many years it was net losses for JCPenney. Net income divided by sales. Divided by sales. All right, so let's calculate this number here. Equal sign. Net income divided by sales, equal sign. Click on income statement. And look for net income somewhere down here. We must have earnings or something. Net income, row 39, negative. Okay. Row 39, B9. Divided by the revenue number, go to the top. And this is the revenue number, B8. And so this gives me, so they are losing how much? About 1 penny. So they sell goods worth $1, they lose 1 penny. I would say it's primarily because of the cost. They have no cost control. As I said, yes, there could be many contributing factors, maybe they are mispricing, maybe they are buying wrong type of merchandise, could be a bunch of things. But at the end of the day, there could be one reason could be that, they have lost control over their, because they are hiring too many people, they are operating unproductive stores. So the industry average is half a penny approximately. So not very impressive, as you can see. So when in this industry a firm sells goods worth $1, it makes a profit of half a penny. Okay. So let's copy this. Okay, and copy these down, the cross-sectional and time series, and delete these values. So JCPenney is, as you can see, below the industry average. Okay, the next one is return on assets. So now we are looking at things from the investments perspective. Investment. So once again, net income in the numerator, and we divide it by total assets. Total assets. So what we are saying is, okay, let's forget the sales. Let's look at total assets. Are their assets producing any income or not? Once again, you are going to see a negative number because the numerator is the same. So all these ratios, they will, 1, 2, and 3, because the numerator is negative, so all these ratios will be negative. So net income divided by total assets. So here we go. Net income, equal sign, click on income statement. The same net income number we used before, minus 116, B39, and divided by, now we need to go to the balance sheet and click on total assets, and these are total assets here in B21. All right, so income statement B39 divided by balance sheet B21. So what's the answer? Negative 1.5 pennies, so to say. So, or 1.3%. So for each dollar of investment in assets, JCPenney is losing 1.5 pennies, or 1.3%. All right. So as I said before, in my opinion, costs are more important than anything else. they are not cost efficient.